Okay, let's just jump right in. It's Thursday, February 5th, 2026, and if you really want to know if the economy is recovering,
Mhm.
for real, you should probably stop looking at the S&P 500 and start looking at the interstate.
Exactly. The stock market is sentiment, trucks are reality.
And that's our mission for this deep dive. We're
Mhm.
looking at XPO. They are, a massive player in the logistics world, and they just dropped their Q4 2025 earnings report.
Mhm.
And the stock is popping. It's up nearly 3.3% in extended trading.
Mhm.
But here's the thing that really confused me when I first read the press release. This this looks like a company that's booming in a recession.
It does. It definitely looks like a paradox on paper.
Right. I mean, they beat revenue
Yeah.
expectations, $2.01 billion. They
Right.
beat earnings per share. But then you dig in, you look at the actual operations, and they moved less stuff than last year. Tonnage is down.
Yep.
So the question I have for you and what we need to figure out is how does a shipping company make record profits when they're shipping less freight?
It's the $1 million question, or in this case, the $2 billion question. And to answer it, we have to understand that XPO isn't just trucking. They operate in a very specific part of the world called LTL, less than truckload.
Okay, pause there. I see LTL all over these documents. Before
Really?
we get into the numbers, can you just explain that? Like, why is LTL so different from just hiring a guy with a semi to drive a trailer from New York to LA?
Okay. So truckload shipping is easy. You fill a trailer with, say, toilet paper at a factory, you seal it, and you drive it to a Walmart distribution center. One pickup, one drop off.
Yeah.
Simple.
Yeah.
LTL is Tetris.
That's right.
Yeah, Tetris. I mean, imagine you have a pallet of paint from one company, a crate of engine parts from another, and 3 boxes of clothes from a third.
Okay.
None of them have enough to fill a whole truck. So XPO picks them all up locally, brings them to a service center, unloads them, sorts them, then puts them on a bigger line haul truck to move them across the country, unloads them again at another center, and then finally delivers them.
Wow. Okay, that sounds like a logistical nightmare compared to just driving straight through.
It is. It's incredibly complex.
Ooh.
But that complexity is where the margin is, if you can get it right. And what this Q4 report tells us is that XPO is getting it very right, even though the broader industrial economy, the people actually making the stuff, is still, struggling.
And they were pretty blunt about that struggle. I think the CEO, Mario Harik, he called it a trade downturn.
She did. He also used the phrase subseasonal industrial environment, which is, polite CEO speak for factories haven't been making much stuff for 3 years.
Right.
And if you look at the raw data, their tonnage per day was down 4.5% year over year. October, November, December, all negative.
So the pie is shrinking.
Yeah.
And normally in Econ 101, when demand drops, prices drop, right? You slash your rates to try and keep your trucks full. But XPO, they didn't do that.
No, they did the exact opposite. And this is what you call the contrarian strategy. They raised prices. Their yield, which is basically the price they charge for their service, excluding fuel, went up nearly 6% for the full year.
Hold on. If I'm a shipper and business is slow, I'm pinching every penny. Why would I agree to pay XPO 6% more when I could probably find a cheaper carrier who's desperate for the work?
Because cheap is expensive if your freight gets destroyed.
Fair point.
Mario Harik hammered this point on the call. They've reduced damages to company record lows. In the LTL world, because you're loading and unloading that pallet 4 or 5 times, the risk of damage is really high. If XPO can basically guarantee your shipment arrives in one piece, you'll pay the premium.
So it's a flight to quality.
Exactly. But there's a second reason for the price hike, and this is a strategic pivot they've been working on for a while. They're firing the wrong customers and hiring the right ones.
That sounds aggressive, firing customers.
It's necessary. They're shifting their mix toward what they call local customers. These are small to medium businesses. So think of like a local hardware chain or a regional manufacturer, not a massive national retailer.
But wait, usually in business, you want the whale, right? You want the giant contract with the Fortune 500 company because it guarantees volume. Why would they walk away from the giants to chase the little guys?
Leverage. If you're a giant retailer shipping 500 truckloads a day, you walk into that negotiation with a baseball bat. You demand rock bottom rates.
Right.
But if you're a local business shipping 5 pallets a week, you don't have that power. You care more about the truck showing up on time than, saving 2 cents a mile.
So the local customer just pays better margins.
Significantly better. And they're stickier. It's much harder for a competitor to steal 10,000 small accounts than it is to steal one giant one. XPO grew this local segment to about 25% of their revenue, and they want to get it to 30%.
Which explains the headcount in sales then. Because selling to 10,000 boutiques is a lot more work than taking one CEO out to lunch.
It is, but the payoff is resilience. When the big guys squeeze you on price during a recession, that local mix protects your margin. And that's how they got record-adjusted EBITDA margins in a down market.
Okay, so strategy one is charge more by targeting the little guy and breaking less stuff. But you can't just price your way to prosperity if your operations are messy. And this is where I want to dig into the tech section of the report.
Efficiency engine.
Yeah. I usually roll my eyes when companies say AI. It feels like a buzzword they just sprinkle on earnings calls to make the stock go up. But XPO claims this is actually on the road, moving trucks. Specifically, they talked about route optimization for pickup and delivery, or P&D.
And this goes right back to our Tetris conversation. P&D is the hardest part of the job.
Why? I mean, isn't it just GPS, turn left, turn right?
Not even close. Think about the complexity. A driver has a trailer. They have 15 stops to make in a city. Some are pickups, some are deliveries, some customers close at noon, some require a lift gate because they don't have a loading dock, some are in these tight alleyways.
Okay, I see. That math problem.
It's the traveling salesman problem on steroids. In the old days, dispatchers just guessed the best route. Now, XPO has piloted these AI tools that factor in all those constraints: traffic, time windows, equipment, pallet count, and they sequence the route perfectly.
And does that actually save money? Or is it just a cool piece of tech?
They gave us the receipt on the call. This is actually one of my favorite parts of the transcript because they quantified the value of 1 point of efficiency.
Run those numbers for me again.
Okay, so for line haul, that's the long highway driving between hubs. Every 1 point of efficiency improvement there adds $16 million to the profit line.
$16 million for 1%.
Right. For P&D, the local city driving we just talked about, every point is worth $9 million. And for dock efficiency, how fast they move stuff across the warehouse floor, it's $4 million per point.
That is just staggering. When you look at it that way, you realize why they're so obsessed with this. If the AI gets like 5% better, we're talking about massive money falling straight to the bottom line without selling a single extra shipment.
Precisely. And in 2025, their productivity improved about 1.5 points. But in the second half of the year, as these tools started rolling out, it accelerated to over 2 points. They're planning to expand this P&D tech to 50% of their service centers in just Q1 of 2026.
So we haven't even seen the full benefit yet.
We're just scratching the surface. And this efficiency allows them to do something else that is absolutely critical: insourcing.
This was that purchase transportation stat, right?
Yeah.
Down to 5.1%.
A historic low. Purchase transportation is basically outsourcing. When you don't have enough of your own trucks or drivers, or your planning is bad, you have to hire a third-party carrier to move your freight. That's expensive.
It's like calling an Uber because you didn't plan your day well enough to drive yourself.
That's a great analogy. XPO has reduced that reliance to almost zero. 95% of the time, it's an XPO driver in an XPO truck. That controls cost, but it also circles right back to your first point: service.
Right.
An XPO driver is trained to handle the freight. A random third-party driver might not be.
So the tech drives the efficiency. The efficiency kills the outsourcing, and the lack of outsourcing improves the quality, which lets them raise the price.
It's a flywheel.
I want to talk about one more specific strategy they mentioned, because it sounded, well, fancy: premium services. Specifically, this grocery consolidation thing. They said, this is a billion-dollar opportunity. What exactly are they doing here?
This is a perfect example of solving a headache rather than just moving a box. Imagine you're Kroger or Walmart. You have a massive distribution center. You have hundreds of small suppliers, the guy who makes the artisanal salsa, the company that makes the specialized crackers.
Right, and they all want to ship their product to me.
And if every one of those 50 suppliers sends a separate truck to your loading dock, you have a traffic jam. You have 50 drivers checking in, 50 sets of paperwork, 50 trucks idling in your yard. It's just chaos.
I hate traffic jams.
So XPO steps in. They tell those 50 suppliers, don't drive to Kroger, drive to us. XPO takes all that salsa and crackers, puts it onto one single trailer, and books one appointment at the Kroger distribution center.
That is brilliant.
The grocer loves it because their dock is clear. The suppliers love it because XPO gets them reliable access, and XPO charges accessorial fees premium pricing for managing that whole consolidation.
And they said they nearly tripled shipments in this segment in the back half of the year.
They did, and premium services now make up about 12% of total revenue. They want to push that to 15% plus. It's just another way to inoculate themselves against a recession. Even in a downturn, people still eat groceries, and grocers still hate traffic jams.
Okay, so we've covered the good stuff, the pricing, the tech, the new services.
All right.
But I have to play devil's advocate here, because there's a number in this report that makes me a little nervous.
I think I know where you're going.
The coiled spring. They keep using this phrase. They are deliberately maintaining 30% excess door capacity. That means 30% of their terminal space is just sitting empty. Empty real estate is not free. They're paying to heat and light and maintain warehouses that are collecting dust. In a recession, shouldn't they be cutting that fat?
Well, if you think the recession is going to last forever, then yes, you cut the fat. But XPO is betting the house that the recession is ending.
So it's a timing bet.
It's a very aggressive capacity strategy. See, the freight market is cyclical. It always has been. When the market turns and industrial demand spikes, capacity tightens instantly. Everyone is scrambling for trucks. Shippers call carriers and get told, sorry, we're full.
And XPO wants to be the one guy saying yes.
Right. If you cut your capacity to the bone to save money now, you can't capture the upside later. You have to rehire, release, retrain. That takes months. XPO is sitting there with empty doors and a young fleet. The average tractor age is only 3.7 years, just waiting for the starter pistol.
Just 3.7 years young?
In trucking, that's brand new. It means their maintenance costs are rock bottom because nothing's breaking down. So they have the doors and they have the trucks.
But the risk is real. If 2026 is another bad year, that empty space is an anchor. It will drag down their earnings.
It absolutely is a liability. It's a fixed cost with no revenue attached to it.
So, are there any signs that this bet is going to pay off? They mentioned January data.
They did. And this is where we need to put our economic barometer hats on. January tonnage was flat year over year.
Flat doesn't sound like a boom. Flat sounds like, well, flat.
Context matters. First, January is seasonally slow. So being flat is actually an improvement over the trend. But then you have to factor in the weather.
The weather.
Yeah.
The classic CEO excuse. We would have made $1 billion if it wasn't for the rain.
I'm usually skeptical of the weather excuse too. But in trucking, a winter storm is a legitimate disruptor. I mean, if the highway is closed, the freight doesn't move. They estimate the January storms cost them 3 percentage points of tonnage.
Okay, so if you add those 3 points back, they would have actually been growing.
Exactly. They would have been positive. That's a green shoot. But the more important signal for the listener, even if you don't own XPO stock, is the ISM index.
The Institute for Supply Management.
Right. XPO management highlighted that the new orders component of the ISM manufacturing index hit 57.
And for those who don't track this daily, 50 is the magic number. Yeah.
Yes. Anything below 50 means manufacturing is shrinking. Above 50 means it's expanding. 57 is a strong number. It means factories are ordering raw materials.
And if factories are ordering raw materials, somebody has to move them.
Exactly. Raw materials are heavy. They move on LTL trucks. If that ISM number is real, it means the industrial softness we've seen for 3 years might finally be over. The freight recession could be ending, like right now.
And XPO sitting there with 30% empty doors just rubbing their hands together.
That's the coiled spring. They are ready to explode upwards the moment that volume hits.
Let's talk about the company's checkbook for a minute. If they're keeping all this capacity and investing in AI, are they burning through cash?
Surprisingly, no. They're generating a lot of it. The CFO, Kyle Wismans, gave guidance that free cash flow is expected to increase by more than 50% in 2026.
A 50% increase? How?
2 reasons. 1, the profit margins are up, like we just discussed. But 2, capital expenditures, CapEx, are coming down. They spent the last few years buying those new trucks and expanding those terminals. The shopping spree is over.
So the credit card is back in the wallet?
They're moderating spending to about $500 to $600 million. Now, they just run the network and collect the cash.
And what are they doing with that cash?
Cleaning up the balance sheet. They're paying down that net leverage is down to 2.4x, which is very healthy. And they're buying back shares. It's a very shareholder-friendly pivot.
So to summarize all this, we have a company that used a 3-year recession to fix its operations. They implemented AI to handle these complex routes. They shifted their sales team to target higher-margin local businesses. They insourced their driving to control quality. And they refused to sell off their real estate betting on a recovery.
That is the perfect summary. If I had to put it on a bumper sticker, it would be XPO fixed the roof while it was raining.
I like that. Most people wait for the sun.
And now, looking at the January data and those ISM numbers, it looks like the sun might finally be coming out.
So for the listener who is just trying to understand the world, why does this deep dive matter?
Because freight is the physical reality of the economy. We live in a digital world, but we eat physical food, we wear physical clothes, and we build physical houses. If XPO is seeing a pulse, it means the heart of the American economy is starting to beat stronger.
It's a leading indicator.
It is. If XPO is right, 2026 is going to be a growth year for everyone, not just for logistics companies.
But I have to bring it back to the risk one last time.
The provocative thought.
Yeah. Leave us with the scary part.
The scary part is that 30% empty space. XPO has built a machine that is designed for a booming economy. They are paying for that machine every single day. If the economists are wrong, if that ISM number was a fluke, if the consumer pulls back and the recession drags on for another year.
Then XPO's the guy who threw a massive party and nobody showed up.
Exactly. They are overexposed to the recovery. If the recovery happens, they win big, bigger than anyone else. But if it doesn't, that excess capacity becomes a massive financial anchor. They have placed their chips on the table.
They're betting on America getting back to work.
They are. The question for you is, are you willing to make that same bet?